My name is Gary Kamen, the voice of Trends and Futures. Welcome to this edition of the Trade to Win educational series, where I'll cover the commitments of traders, Traders and Financial Futures Report. This report, released each Friday, was first released back in July 2010. Why was it created by the CFTC? Well, for better transparency. Transparency of what, you may wonder? Well, let's have a look. What you are looking at are the 6 largest investment banking institutions in the world that hold derivatives for trading. Until its final repeal in 1999, the Glass-Steagall Act kept separate investment firms and commercial banking. In 1933, commercial banks were accused of being too speculative in the pre-Depression era, which gave birth to Glass-Steagall. So since 1999, investment firms and commercial banks were free to marry. So what has happened in dollars and cents over the past 12 years? Let's have a look. Now the table you're looking at comes from the Bank for International Settlements website, that's BIS.org, and it's the amounts outstanding of over-the-counter derivatives. And what's quite staggering here is it's in billions of dollars. So as of June 2011, total contracts held were in this amount right here. And that's actually $707,569 billion. $707 trillion. That's notional amounts outstanding. Gross market values are at $19,518 billion. That's right here. Here's your currency contracts held for trading. Notional value, $64.698 trillion. The largest contract traded, of course, are interest rates, $553,880 billion. Our equity-linked contracts, the S&P, the Dow, $6,841 billion, right there. In the commodities, we're looking at $3,197 billion. Again, over-the-counter derivatives held for trading. Look at the options numbers here. In foreign exchange, you're looking at $11,358 billion for options trading. Interest rates, $56,423 billion. Here's $4,813 billion in equities, and only $883 billion in options for commodities. So remember, these notional amounts outstanding for trading are as of June 2011. Right now, we're in April 2012. And look at the increase, $601 trillion, $707 trillion. So in the U.S., who holds all of this? Let's have a look. And this is the distribution of derivative contracts by the top 25 commercial banks and trust companies in derivatives as of December 31st, 2011, and this is in millions of dollars. And right here, look at your first 6, right in here. Those are the same 6 I showed you earlier. The top 6 are JP Morgan Chase, Citibank, Bank of America, Goldman Sachs, HSBC, and Wells Fargo. Top 25, of course, end with BMO Harris Bank, and these are banks in the U.S. See the states they're from? What's very interesting here is if you look at the first 4, right in here, that's JP Morgan, Citibank, Bank of America, and Goldman Sachs. Their numbers come to $216 trillion. So of that $707 trillion, these 4 here, 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 and here control 30% of that $700 trillion. So this is why the Traders and Financial Futures was created by the CFTC, to watch this money move through the markets. So what exactly is the Traders and Financial Futures? The Traders and Financial Futures, announced by the Commodity Futures Trading Commission on July 22, 2010, builds on improvements to transparency implemented in 2009 that disaggregated data in the CFTC's weekly Commitments to Traders reports. The new report separates large traders in the financial markets into the following 4 categories: dealer intermediary, asset manager institutional, leveraged funds, and other reportables. The legacy COT report separates reportable traders only into commercial and non-commercial categories. The TFF report, like the other COT reports, provides a breakdown of each Tuesday's open interest for the markets in which 20 or more traders hold positions equal to or above the reporting levels established by the CFTC. This report is published in futures only and futures and options combined formats. The TFF report is published side by side, like the disaggregated report, with the legacy report. Now let's look at the trader classification. The TFF report divides the financial futures market participants into the sell side and buy side. This traditional functional division of financial market participants focuses on their respective roles in the broader marketplace, not whether they are buyers and sellers of futures option contracts. The category called dealer intermediary, for instance, represents sell-side participants. Typically, these are dealers and intermediaries that earn commissions on selling financial products, capturing bid-offer spreads and otherwise accommodating clients. The remaining three categories, asset manager institutional, leverage funds, and other reportables, represent the buy-side participants. These are essentially clients of the sell-side participants who use their markets to invest, hedge, manage risk, speculate, or change the term structure or duration of their assets. And this is important. Some parent organizations set up separate reportable trading entities to handle their different businesses or locations. In such cases, each of these entities files a separate Form 40 and is analyzed separately for determining that entity's proper TFF classification. A trader's classifications may change over a period of time for a number of reasons. A trader may change the way it uses the markets, may trade additional or fewer commodities, or may find that its client base evolves, for example. These changes may cause DMO staff, which is a division of market oversight, to change a trader's classifications and categories and or change the commodities to which a trader's various classifications apply. Moreover, a trader's classification may change because the commission has received additional information about the trader. So JP Morgan Chase can actually be an asset manager and actually could have leveraged funds. And also, they're dealers. So divisions of a larger organization can fit in separate categories. Let's have a look at the individual categories. And let's look at the sell side first. Dealer intermediary. These participants are what are typically described as the sell side of the market. Though they may not predominantly sell futures, they do design and sell various financial assets to clients. They tend to have matched books or offset their risk across markets and clients. Futures contracts are part of the pricing and balancing of risk associated with the products they sell and their activities. These include large banks, U.S. and non-U.S., and dealers in securities, swaps, and other derivatives. And now for the buy side. Asset manager institutional. These are institutional investors, including pension funds, endowments, insurance companies, mutual funds, and those portfolio investment managers whose clients are predominantly institutional. Leverage funds. These are typically hedge funds and various types of money managers, including registered commodity trading advisors, registered commodity pool operators, or unregistered funds identified by the CFTC. The strategies may involve taking outright positions or arbitrage within and across markets. The traders may be engaged in managing and conducting proprietary futures trading and trading on behalf of speculative clients. Other reportables are very similar to the disaggregated report. Reportable traders that are not placed into one of the first three categories are placed into other reportables category. The traders in this category mostly are using markets to hedge business risk, whether that risk is related to foreign exchange, equities, or interest rates. This category includes corporate treasuries, central banks, smaller banks, mortgage originators, credit unions, and other reportable traders not assigned to the other three categories. Now, before we have a look at a few charts, let me be clear. There is no correlation between the legacy report and the traders in financial futures. There is correlation between the legacy report and the disaggregated report. So let's take a look at our first chart. And the first chart I want to look at is the E-mini S&P. Now we're looking at a weekly chart of the E-mini S&P. And if you look down at the bottom, this is the old legacy report, the three-line report. You've got commercials, large spec, and small spec. Small spec's the blue line, large spec's the green line, and commercials, they're the red line. And you see 3 years ago, the S&P was trading at 850, right in here. And look what was happening in this area here. You had small spec in an extreme net short position. You had commercials just below the zero line right in here. And large spec were long. And you come here to the low back in 1,000 here. You see what's taking place in here. You see how the market came off from 1050 here, rolled all the way up to above 13 with really no look back except for this area right in here. And then you see a lot of consolidation here. And then the market went from 1100 right in here, had a setback right here, but then shot straight up to 1400 right in here. And what was taking place there? Commercials were in extreme net long positions. Large spec were in extreme net short positions. So what's happening here? Why is this market doing this when all you see taking place is liquidation? You see commercials liquidating here, and you see some liquidation taking place by large spec. But what is really taking place? Well, let's look at the new Traders and Financial Futures report, and that'll tell us. Here's a legacy report we just looked at, right in here. Here's the new Traders and Financial Futures report right here. And what took place on this dip right in this area here? Well, we did see liquidation. We saw liquidation by asset managers right in here. And we saw liquidation by dealers right in here, the red line. Green line's asset managers, the red line is dealers, the blue line is leverage funds, and the orange line is other reportables. And here's leverage funds. What are they doing? They're short in this area, right in here, at the low point of the price, right in here. Net longs, net shorts, asset managers, dealers, and some slight liquidation here by leverage funds, right in here. See that? And the market comes up, primarily from this buying and this selling right in here. This really does show in this area here a much nicer picture than what's going on right in here. And remember, there's no correlation between this red line and any lines here, or this green line and any lines here. This is a completely different report. So you can see here, additional selling, additional buying helps push the market up. Again, asset managers, dealers. Remember, the notional value is held for derivatives trading. Now that's in the E-mini S&P. What about T-bonds? And if you recall, interest rates were the largest chunk held under the notional value of derivatives. And again, we're looking at just a legacy report here. And what are we seeing? We see commercials adding to net longs, large spec adding to net shorts down here. The market comes down. We're at these lows here. Market comes up. On liquidation, it looks like, right in here. See how the market comes up here? Consolidation right in here. Market tops off at 136. Then we see this take place again. Market comes down to these lows right in here. And again, these are tagged as commercials, the red line. The green line is large spec. And you see this nice ride up here all the way to 146. And again, this is a weekly chart. So what's really taking place with big money? Let's look at the more transparent report. And this does also paint a different picture. Here you see the lows here. And look what's taking place. You see what's happening? Asset managers have a large net long position here. And dealers are net short right in here. And so are leverage funds right in here. Liquidation takes place here. Market's coming up. And then we see some liquidation here. Market comes down. We have some more buying and selling taking place right in here. Market comes up. And then when leverage money comes in to add to their selling right in here, look what happens. And now you see what's taking place right now. Is the bond market's in a nice weekly range here between 136 and I'll say 146 right in here, or maybe 144. You see the consolidation here. So do we have to be concerned about a market correction? That is a very good possibility. Now what about currencies? Now Forex traders ask me this all the time. Can I use this report to help me trade Forex? Well, let's take a look. While there is no COT report for cash currencies, there is for currency futures. And I'm just taking a look at the euro and US dollar right now. And here's the legacy report right here, and the new traders and financial futures report right in here. And this really tells a good story. Here you got dealers as the price of the euro gets high. You see that here. Asset managers are nowhere near as heavily involved in this market as leverage funds and dealers. You see that right there. So we have a nice high here in the euro, right in here. Well, this really large drop takes place. And look what's taking place. Dealers are starting adding to their net longs. Leverage funds are adding to net shorts. Market comes down. We have a low here, right in here. Change in direction by big money. The euro comes up. We have this little drop here in the euro. Change in direction. And then we see another change in direction here. The euro has a range here. And then what happens? Let's bring the euro down. And this time, asset managers got involved. And the euro comes down. And once again, the euro's playing with 130 right in here. Now, inverting this chart, you have the US dollar. We had a nice ride up here. You see that? Market came down really hard when dealers started adding to net longs and leverage funds started adding to net shorts. You see the US dollar drop. Here's a low here. And then what took place right here? You see this change and this change. Market came up. Here's the high right in here. Then all of a sudden we saw the market come down again. Here and here. Market dropped. Market starts coming up again based on buying and selling of dealers and leverage funds. You see that here. Then there's some liquidation here took place. We had another low. And the last run up in the dollar, as it came off of 74 here, you saw what took place. Here and here. And look what happened to the dollar. Some liquidation here and here. Dollar came down, buying and selling increased, but look at this. Leveraged funds were liquidating. Dealers were actually acting at shorts, and who was buying that? Asset managers. See that right there. Now, keeping an eye on these groups, you'll know if the dollar is going to break through 78 and head south and retest 75 or maybe 73, or if the dollar is going to break out of 80 and retest areas up here. That's all due to the buying and selling of big money. And if you recall the number of big money, that was $707 trillion of notional value. Now finally, traders and financial futures implementation. Taking the 30-day trial to trendsandfutures.com is the best way for you to learn how to use the newer COT report for financial futures. You will learn something very few traders ever learn. What lies beneath all trends. Or basically, what lies beneath all market moves. It's always about the buying and selling. Could watching the names below move money around the markets help you? I know it can. Are you really willing to bet it can't? So take the 30-day trial to Trends and Futures. I guarantee you'll be a more knowledgeable, informed trader. So this is Gary Kamen, again, the voice of Trends and Futures. And until next time, be well, trade well, and follow the trends.